Ives, Managing Director of Equity Research at Wedbush Securities. He's on neutral on the stock. Garrett Nelson with us, also Senior Analyst at CFRA, has a sell rating on the stock, a price target 150. Dan, I went straight to automotive gross margin, which a lot of people were looking for. 19%, I think, misses forecast.
Oh, clearly. This is, for the bulls, this is a disaster story in terms of that gross margin. You already knew what demand was in terms of growth, but it comes down to, can they do this profitably? You need to see something with a 2 in front of it. This is something that's definitely be a gut punch for the bulls in terms of that gross margin number.
Explain why that margin is coming down. Is it because people aren't buying the more expensive models, the S, and they're buying the cheaper models instead, or is there something else going on?
That's really the crux of the bull bear thesis right here, is that can they be profitable with lower priced, lower margin units? And that's really been the issue. You could sell more cars. Can you do it profitably? If not, ultimately this company will have to raise more capital next year. That's why it's such an issue for the street.
Garrett, that said, deliveries as expected, obviously coming in at 93,000. We'd had the guide to that. Revenue was basically in line, and the guidance on deliveries for the rest of the year was not cut. So do you think the share price reaction to the downside is overdone?
We think this is an extremely demoralizing release for Tesla. I say that because the stock had bounced almost 50% from the low in early June. And there was some expectation that they might beat here. The bar was pretty low for the quarter, but they lost $1.12. It was a big miss during a quarter in which they had record vehicle sales, record high vehicle sales. So you have to look at this and question what the path to profitability looks like for Tesla going forward if they can't generate a profit on record high sales.
I was going to say, so for all these reasons, obviously, new caution here in terms of looking at how the stock is reacting. We know it can swing one way or the other, but the setup going into this number was very interesting, and it's basically the path of maximum frustration. Massive collapse below 200. Short sellers, if they got really aggressive there or stayed aggressive, they got killed on the way up. The stock comes right back up to 260, which was the absolute bottom of like a 1.5 year long range. And so this report was going to say, okay, is it going to be allowed back into that range, or is it going to be denied? And for now, it looks like it's getting smacked below it. So on a technical basis, people are going to say that was a head fake move to the upside.
Dan, full year guidance of 360,000 to 400,000 deliveries. They haven't adjusted that. If they hit that by the end of the year, does the focus on the gross margin go away a bit, or is it still key to you?
Well, I think it's still a focus, but no doubt that would take away the sort of doomsday scenario. And I continue to think whisper numbers are called 340 to 350, and that 360 to 400 continues to be a massive challenge. And just like Garrett talked about, if you look at the profitability here, this was a Goldilocks quarter and you lost over $1. That's really going to be, in my opinion, the gut punch for the bulls.
I'm just looking, there's so much commentary in this letter as they release it beyond the numbers, which is good to get, Garrett. So what we've learned is that average selling price was stable, which was a question for the Model 3 at $50,000. Manufacturing costs declined. That's positive incrementally, right? The Model SX, which there were questions about demand and the more expensive units, deliveries increased sequentially to 17,722. So what's the demand story shaping up to look like here?
The problem is they posted about a 19% automotive gross margin for the quarter. That's a step back from what they did in the first quarter. And it's because 4 out of every 5 vehicles they sold during the quarter were Model 3s. That's an inherently lower margin vehicle, and that's a problem for them. Customers aren't buying as many Model S and Model X vehicles, and really the next catalyst is the opening of their China factory. But the problem with China is auto manufacturers are notorious for struggling from a profitability standpoint over in China. And the China auto market, from a demand standpoint, has pretty much collapsed over the last year. So this isn't a pretty picture for Tesla.